This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 102.5 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans. Or you can talk to him right now at 407-916-5400.
Well, good morning, ladies and gentlemen, and welcome to the program Dollars and Cents. My name is Joel Garris of Nelson Financial Planning, and you're listening to us live here on News Radio 102.5 WFLA. On the program, much to talk about, as you might well expect, with it being tax time. We'll talk about taxes, of course, because that's probably a topic that is on everybody's mind. Got some comments on some of the unintended consequences of the 2018 tax changes. So not the ones that you're working through right now, but the ones that you need to be aware of so you can plan appropriately for the rest of this year. Also, some of the comments will focus on what we're seeing on 2017 returns, some of the biggest changes that we're running into as we talk with people about their tax returns that have completed for 2017. Well, we've got some interesting stats on volatility, which, of course, I guess requires us to talk a little bit about what kicked off some volatility this week. But first, some comparison or some perspective on that. One of the things that we've been saying for quite some time is that the past year or so has, in fact, been a relatively calm period of time. In fact, abnormal based upon the lack of volatility in the overall markets. In fact, that increase last year was so smooth without any declines that it did, in fact, set a record. 15 consecutive months is the record, and in the current market prior to this month tied it in terms of the number of consecutive months with total return gains. Obviously, now that February has closed, because we're sitting here already into March, I'm not sure how that happened so quickly, but so February's in the books as a down month, the first one in 16 months, which then means that the current market set the record or tied the record for consecutive months of positive total gain during the course of a calendar month. So relatively a smooth period of time. In the month of February, again, to put some perspective on that, the month of February has had 11 trading days. So within, actually, these are just the first 20 trading days. The first 20 trading days of February, which would be through last Friday, 11 trading days that had at least a 1% total return up or down. Okay, because remember, volatility is an up or down proposition, right? If we talk about something that is volatile, it means that it goes up quickly, it goes down quickly. If you've got a higher level of volatility, then that is happening on a more frequent basis. So volatility, remember, doesn't just mean bad things. It can also mean good. Anyway, Through last Friday, the S&P 500, 11 trading days during the course of the month where there was a 1% up or down. Okay. Prior to that, there were 11 trading days that were 1% up or down in the preceding 305 days. So let me see if I can say that again to have it hopefully make more sense. So in the prior 305 days, there were 305 trading days. There were 11 times when the market moved up or down by 1%. In February, this month, there were 11 days when that happened. And if I'm trying to remember, the beginning of the week was a long time ago for me, folks. But I think there was maybe a 12th or 13th in there, just in the first 3 days of this week. The point being that to find 11 days, so we had 11 days in 20 during the month of February, during the first 3 weeks of February. You have to go back a total of 305 days. Okay, so that's well over a year because we're talking about 305 trading days. So those are weekdays, not the weekends, right? So you got to go back 305 trading days before you'll find 11 days where the market was going up and down. So by more than 1%. So again, an interesting statistic that really helps to put in perspective just how smooth the past year has been, where you've got to look at that in a 305 trading day window to find 11 days where the market was going up or down by 1%. And then here comes February, and you only got to look at 20 trading days to find 11 such occurrences of the market going up or down by more than 1%. So clearly volatility has kicked up, and certainly this past week was no different, particularly with this conversation about tariffs. I'm wondering if it's just conversation. That seems to be the MO of the current administration, is to be provocative on the comments, but not quite so provocative on the actual implementation, right? I guess you could also probably say how the administration is approaching the gun debate also has shifted quite a bit over the course of the past couple of weeks. Initial strong, depending upon which side of the equation you're on, I guess, initial reaction to the tragedy at the Florida high school, just awful. Okay, and then sort of a change from that. So part of me thinks that this tariff conversation is sort of just that, one of those things that we throw out to get a reaction, to put people on notice. The more you make people a little bit more unsure of what the footing is, the more you achieve a better bargaining or negotiation position. I certainly did not read The Art of the Deal, but there's certainly some logistics to how that, in fact, would play out, right? I mean, you say something kind of off the wall, take an extreme position, and force the other side to react to that, and then that changes the line on where you might ultimately come down to a resolution. So I think some of this may be just kind of that type of posturing, because the reality is, I'm not sure which economic data you're looking at, but the economic data that I look at and the studies and the conclusions that I'm reading say that a tariff would be a bad place to start. And clearly the market had a pretty harsh reaction to that this past week. Ultimately, the market digested it probably with the same type of logic that I'm using here right now, in that at the end of the day, it may very well have been some posturing. But clearly, there was a tough week for the market. I think the Dow was down about 3%. The overall broad-based S&P 500 was down about 2%. So not an awful week by any stretch of the imagination, but still not a positive one. And a lot of that was a reaction to this tariff conversation. So watch that. That would be our comment on that. Watch that because if that does in fact become rule or law, then I think you've got some Pandora's box effect that could come as a result of that. There will clearly be winners and losers in that, and so you have to be careful about that. So stay tuned on that. Again, I suspect it's really more posturing to help one's negotiation position, but obviously tariffs can dramatically rattle the global economy that we live in. I mean, here's the reality, all right? If you have investments in the market and if you own those large blue chip companies that make up the S&P 500, what most people don't realize is that about half of the revenue, half of the profit of every one of those companies, even though they're U.S. companies, headquartered here in the U.S., comes from outside this country. So you got to be careful about those relationships. But again, we'll see. As is often the case with the current administration, you hear a lot of talk and sort of things that get thrown out there. But at the end of the day, it doesn't really ever, I guess, stick and become law. So anyway, some thoughts and comments on that. I wanted to make sure to address that because obviously that was a big topic of conversation. We'll go to the break. And we got Craig in Sarasota. Hang in there. We'll take you right out of the break. I was bumping up to one, saw your call come in. We'll take your call right after these words here on Dollars and Cents. This is Joel Garris, Nelson Financial Planning, News Radio 102.5 WFLA.
You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, Dollars and Cents. This is Joel Garris on News Radio 102.5 WFLA. We will go, in fact, straight to those lines at 407-916-5400. We've got Craig from Sarasota. You don't get us all the way down in Sarasota, do you?
No, I'm living Longwood.
Okay.
We're traveling.
Okay.
I listen to your program every Sunday, though.
Excellent. Thanks for calling in, Craig. Looks like you got a question about some Schedule C income.
Yes, I wonder if I can use that income to fund my traditional IRA.
You certainly can, because that's earned income that comes off that Schedule C. The reason that you're able to do that is when you do your Schedule C, the net profit, now obviously it's got to be a profit right, in order to be able to do that, and that profit that comes from Schedule C requires you to pay a FICA tax. And once you pay FICA tax, it becomes, quote-unquote, earned income, work income, and by virtue of that, then you're able to fund an IRA up to the maximum amount, which is $6,500, assuming you're over 50. Are you over 50 or under 50?
Yeah, I'm 69.
Okay, so over 50, so you can do You can do that. Yep, you can do that. That $6,500.
Do I need to reduce that net amount by the credit I get for half the Social Security that I pay?
Absolutely. Yes, you would. You don't have to reduce the net amount directly. It comes on the tax return. So what comes to the front page of the tax return is the bottom line from Schedule C, okay. And then right below that, like 10 lines down, is where you subtract out the half the right. employee part for the FICA tax, and then like the next line below that is where you subtract out the IRA contribution.
Wonderful. Okay.
One other comment I would make on it, Craig, while I got you, if you're looking at a relatively high level of Schedule C income, there's also something called a SEP IRA that you can do.
I don't make that much. I used that in the past, but I'm semi-retired. So.
All right. Well, then the IRA will work just great for you there.
All right. Thanks very much, Joel.
All right. Very good. Thanks for that call, Craig. We appreciate it. And then that does open up some lines, 407-916-5400. Toll free, 1-855-545-1025. Those are the numbers to call on in and be a part of the program. Also, if you don't want to get on the air, you can give us an email at joel@nelsonfinancialplanning.com. That's how you can get in touch with us here on the program. 407-916-5400. Toll free, 1-855-545-1025. So Craig asked a great question about taxes. As we're working through taxes in the office, there are, in fact, some general trends that we're really starting to see. So we'll talk about the trends in 2017, and then also we'll hit 2018 as well. Based upon the numbers that we've seen for 2018, or at least the projections for 2018, it's estimated that 94%, which is pretty much everybody, will in fact see their taxes go down. Of course, that does leave the other 6% that will see their taxes go up. And we continue to see examples of folks in that group, not from where you would think, right? You would think, oh, well, that's got to be a high income earner or something like that. No, the reality is that many in that category that will see their taxes go up are in fact the ones that are taking deductions and itemizing. One of the examples that we saw this past week, and we've talked about other examples on a prior radio program, but one of the ones that we saw this past week is your traveling salesperson. Your traveling salesperson, right? Mileage on the car, or maybe it's even out-of-pocket costs to stay in a hotel, or out-of-pocket costs for meals, or all of that stuff. Those are generally, assuming that your employer doesn't reimburse you, they become unreimbursed employee expenses, whereupon you get to write that off. Well, if you're in the sales business and you do a lot of traveling and you've got a lot of those types of expenses that your employer doesn't cover, then you've always in the past been able to take those as a deduction on your tax return. Well, and for 2018, that's one of the things that goes away. You no longer have that deduction at all to be able to work with, and so consequently, that will be a change for that group of people that would take advantage of that deduction, and that's generally kind of your traditional traveling salesperson, where you would get enough of those expenses that your employer might not be covering, that ultimately winds up with you having to take, I guess, from a tax perspective, you're not going to get the benefit on them because that deduction goes away. So just be aware of that. If you're in that category, then, yeah, that's a deduction that you lose. Many people will find that they wind up moving over to the standard deduction for 2018, and those write-offs that they previously had either doesn't make sense to take because you're not above the standard deduction, which is $24,000, or if you're both over age 65, it's $26,600. Those are pretty big numbers. And so consequently, you wind up not really getting the direct benefit like you used to based upon that write-off. But another example we saw just this past week deals with those categories of those unreimbursed employee expenses, where you would typically see those to be higher for folks that are kind of on the road, out visiting clients along the way, staying in hotels, having meals, things like that. That deduction, in fact, was completely eliminated. So a bit of a change that you need to be aware of as you look forward to 2018. If you're in that category, certainly you want to kind of look at and run the numbers on it. The good news is that the tax brackets are all down, but the bad news is that will help offset for the loss of the deduction that you previously had. So you may very well find yourself in that much smaller group of the population whose taxes go the other way. Again, that's about 6%, so it's not obviously a huge slice, but to the extent that you're in that slice, clearly you're affected in the wrong way that you want to be. So, but certainly some things to be aware of and to think about in the plan as you look ahead to 2018. Excuse me. We've got some things that we want to talk about in terms of the trends that we're seeing in 2017. But I need to clear my throat, so we're going to take a break. And during the break, we've got open lines, 407-916-5400, toll free, 1-855-545-1025. This is Joel Garris of Nelson Financial Planning on News Radio 102.5 WFLA.
This is Bud Hedinger. You can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
It must be allergy season. That's what it must be. Okay, I was having a problem getting through that last segment. And then normally I bring up water, but there's a nasty note on the door, which I usually ignore most mornings because it's Sunday and no one's here to enforce it, that says you're not allowed to bring any water or liquids into the studio. Normally, in fact, I kind of ignore it if I've got, but I didn't have anything with me. So anyway, it's allergy season for sure. And look out on the little outdoor kitchen area at the house, and it's like a coat of nice yellow there. So anyway, thank you for bearing with us as we kind of went into a coughing fit there at the end. Hopefully we'll be able to avoid that in this segment of the program. The numbers to call in and be a part of the program is 407-916-5400, toll free 1-855-545-1025. Those are the numbers to call in and be a part of the program. If you're feeling a little shy, you can also send us an email. That email is joel@nelsonfinancialplanning.com. That's how you can get in touch with us to talk about whatever it is that is on your mind. We prefer it relates to your finances, but, we're fair game on anything, I guess. Craig got us kicked off with a great question on Schedule C income and whether you can fund a retirement account from that. Speaking of working through the 2017 tax returns, there's two trends that I want to make y'all very well aware of, and then one more trend for 2018 to be aware of as well. So, as we all know, last year was a pretty good year for the stock market. So that's good, okay? But generally, that means that you probably are going to have higher capital gains, whether that's on your individual stock portfolio or whether that's on your mutual fund portfolio. Mutual fund portfolio, it's hard for you to control those because those capital gains and the distributions that occur from a mutual fund reflect internal selling inside the fund. So whether it's an index changing out the components of the index, or whether it's an actively managed fund making a decision to, buy Samsung instead of Apple or Apple instead of Samsung, those decisions generate tax consequences that are then passed pro rata to the investors, to the holders of the fund, based upon your slice of ownership of that fund. Similarly, on the dividend side of things, that's the way that works as well. Well, last year, good year, so there was more of a capital gains. Similarly, higher dividends, more and more companies paying dividends or increasing their dividends. And so consequently, you're seeing an uptick on capital gains and dividends. This, to the extent you have an equity portfolio that has some portion outside your IRA. Obviously, if it's all sitting inside the IRA, it doesn't really matter because that's all getting rolled in on a tax-deferred basis, and then you just pay taxes when that money comes out. So dividends and capital gains higher, so guess what that means? That means your taxes go up. It means your taxes go up. The good news is that for last year and for the road ahead as well, dividends and capital gains are still taxed at a preferential rate that for the vast majority of people tops out at 15%. Yes, there is a 20% rate, but that's at very high income levels. The vast majority of Americans are looking at 15%. And in fact, there's also a healthy group that pay at 0, because even though you have income, and it's actually on a joint return up to about $100,000 of total income, will still get you the 0% tax rate on dividends and capital gains. So it's not like you don't have any income and that results in a 0% rate. The 0% rate on dividends and capital gains actually extends through the 15% income tax bracket, which is roughly breaks up to 25 at around the 90, 95, 100 level. So you still have those better rates on the dividends and capital gains, but the reality is that if you're paying 15% on them, and you have more of them, then your tax is bracketed, your tax bill is going to go up. Similarly, what can happen with that if you are a retiree collecting Social Security is you may find yourself in what we refer to as the Social Security trap. And the Social Security trap works something like this. Depending upon how much income you have, your Social Security is either not taxable, or maybe half of it's taxable, or maybe 85% of it is taxable. And depending upon where you fall in that trap of income relative to your Social Security benefits, you may very well find that a $2,000 or $3,000 increase in your capital gains and dividends triggers a $2,000 or $3,000 increase in the amount of your Social Security that you have to include as taxable income on your tax return. So what that means is you wind up having a much bigger tax bill than what you really should have originally expected, even with the higher dividends and capital gains. Those dividends and capital gains would have been only taxed at 15%. Your Social Security income, however, is taxed as ordinary income. So ultimately, the net increase winds up being an extra 15% on the dividends and capital gains, but then an extra 25% on the additional amount of your Social Security. We are running into that awful lot across the board on the tax returns that we see. So be aware, okay, of that shift. Because last year was a good year, then you've got a situation where not only will you have to pay more on the capital gains and dividends, but you could also be triggering more on the Social Security. That's taxed at 25. So a $2,000 or $3,000 increase in your dividends and capital gains could easily trigger another $2,000 or $3,000 of your Social Security being included. 25% on $3,000. Well, guess what? Yeah, that's $750. So you can see where that can really shift it by a few $100s, even though it wasn't that big of a shift on your dividends and capital gains. But because of that Social Security tax trap, depending upon where you fall, makes a very big difference. So just be aware of that. If you have not done your taxes yet, and you're taking Social Security and you've got dividends and capital gains, you may have a surprise on your hands. So you may want to get to that tax return sooner rather than later so you can sort of prepare yourself ahead for what might be a bit more of a tax bill. Similarly, for 2018, if you make quarterly payments, make sure that you adjust your numbers for the fact that your required minimum distribution should have gone up as well, because for your required minimum distribution, it's based upon the value of your IRAs at the end of the year. Well, at the end of the year 2017, if you were owning an equity portfolio, you should have seen a 20 or 25% increase. That means that your required minimum distribution just went up by 20 or 25%, which obviously has a greater tax implication on your tax return. So be careful of that for 2018 and ultimately how your quarterlies play out, because at the end of the day, that's going to trigger some additional tax on your tax return, and then could also accelerate this Social Security tax trap that we've just been talking about. So just be aware of those trends for 2017 that we're seeing. You may want to get to that tax return sooner rather than later, because you may unfortunately find that the bill is going to be a little bit higher. I guess that's the epitome of a good news, bad news, right? Good news is you made money last year. Bad news is now you got to pay more taxes on it. So certainly seeing an uptick on that as a result of the performance. So just be aware of those trends. We're going to slide to a break. During the break, we've got open lines, 407-916-5400, toll-free 1-855-545-1025. And then, of course, the email is joel@nelsonfinancialplanning.com. Give us a call during this next segment of the program. You're listening to News Radio 102.5 WFLA.
The world lost a great Christian when Billy Graham died and graduated to heaven. No person in all of history shared the good news of Christ with more people than he did. Certainly many are Christians today because of his ministry. He'll have incredible joy in eternity visiting with the people that he led to faith in Christ. Yet in reflecting on his life, the quality that I came to respect most was his faithfulness. Faithfulness to God and to God's calling on his life. With all of his gifts, he could have had enormous wealth. He was offered powerful positions in government and turned them down. I'm sure he faced incredible temptations to compromise his faith. Yet he and his team have stayed above reproach, not only respected by Christians, but by people of other faiths and people with no faith. Today, I thank God for his life of faithfulness, and for those of us who follow Christ, may all who come behind us find us faithful as well. This is Bryant Wright, speaking right from my heart.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Well, that was a good ad that I heard. So often you hear ads during these breaks. It's Sunday morning on an AM radio station, right? So you kind of get the offbeat ads. But certainly that last one about Billy Graham, that was a pretty good one. Years and years and years ago, had the opportunity to go to one of his crusades, and certainly very, very powerful speaker, and a man that I think lived his life really an exemplary life, and in a world that's certainly filled with a lot of temptation. So good. It's nice to hear a good ad every now and or at least maybe that wasn't really an ad, although it's probably some kind of a direction, I guess. But anyway, just some editorial comment, which I get to do because it's my radio show. So there you go. Anyway, my name is Joel Garris. You can direct all complaints to the radio station. This is dollars and cents, so we got to get back on topic. But I was thinking a little bit about IRAs versus Roths and the things to look at when you're trying to figure that out on your tax return. And the caller earlier in the program raised the question of whether you could have what types of income allow you to have that to make that IRA or for that matter the Roth contribution, and it has to be earned income. So you have to have work income, something that you've paid the FICA tax on. The only exception to that, and this is a pretty big exception, is if you are the spouse of someone who has earned income, then you are allowed to make a spousal IRA, assuming that their income was at least as much as what the total amount of money that you're contributing was. So another way to say that is if each of you do $6,500, that's $13,000. You need to at least have $13,000 of earned income in order to get that deduction. If, for example, there was only $5,000 of earned income, then between the two of you, you're only allowed to do $5,000. So you're only allowed to contribute to a retirement account up to the amount of your earned income. That's always a threshold. It's not a threshold you hear a lot about, because if you're not making much money, then you probably don't have the ability to fund a retirement account. But the reality is that if you're working part-time, you're semi-retired, might very well be the case. So it's important to note that if you're going to fund a retirement account, there has to be at least enough earned income somewhere on that tax return, whether it's through a W-2 or whether it's through a Schedule C, a self-employment situation. Then you've got to at least be able to show that you've got a level of income that at least is as much as what you're planning to contribute to the retirement account. But the exception of somebody who can do that is pretty broad, because if you're married and your spouse has earned income, then you can also fund a retirement account of your own accord. So that's certainly something that you can do along the way, even though you don't have earned income on personally, but as long as your spouse does, then you are fine. One other minor exception on that is if you are collecting alimony. Alimony is considered not earned income in terms of that you have to pay the FICA tax, but the IRS looks at that as income that would allow you to turn around and make a retirement account contribution for your own accord. So some narrow exceptions and limitations that sort of expand your ability to fund a retirement account depending upon those situations. But the reality is that if you're married or if you're divorced and collecting income on alimony, then you have the ability to fund a retirement account, even though you may not have earned income yourself. So an important distinction there as well. In determining whether you want to fund an IRA or a Roth, well, if you're funding an IRA, you certainly want to make sure that it is tax deductible. So you really need to do the analysis on that IRA to determine whether it's going to be tax deductible or not. And the very first question that you have to ask on that is whether your employer has a retirement plan at work that you were not participating in, but simply eligible to participate in. If they do, then that changes the analysis. How do you know? Well, you look at your W-2 and there's a box 13, and if those boxes, any of those boxes in box 13 are checked, well, then that means you had a retirement plan that your employer offered to you, regardless of whether you participate. Then that changes the analysis to then have to look at where your income comes in. So if your employer doesn't have a retirement plan, then you can absolutely fund an IRA and take a tax deduction for it without any trouble at all, regardless of how much income you make. If your employer does have a retirement plan, then that's when you need to look at your income. If you're single and your income is above $72,000, then you're not able to contribute to an IRA and get a tax deduction for it. Below $62,000 to $72,000, you can do a partial IRA and get partial a bit of a tax deduction. For a married couple, if both are covered by an employer plan, then your income basically has to be below $99,000. It can run up to $119,000 again. There's a phase-out window at $119,000. Then you don't get any tax deduction for that IRA. If one spouse is covered but the other is not, if it's the spouse that is not covered, then the covered spouse still has to observe that same $99,000 to $119,000. At below $199,000, you can write it all off. Above $119,000, you don't get any of it. If you're the spouse of someone and you don't have a retirement plan at work, but they do, there's a different number that applies. That's starts to phase out at $186,000, fully phased out at $196,000. I realize that that's a lot of numbers I just threw at you. Bottom line is, remember the analysis. Does my employer have a retirement plan? Number one. Okay. If they don't, no problem. You can make that IRA contribution, get tax deduction for it. If they do, or if they do for one spouse but not the other and all, then you've got to look at kind of where that income falls to determine whether the IRA is going to be tax deductible. If you can make the IRA and have it be tax deductible, generally we like that approach because we like saving money on our taxes now. If you don't get the deduction for the IRA, then you absolutely have got to look at the Roth, because the Roth has a much higher contribution eligibility limits, up to $186,000 to $196,000, and then it starts to phase out for a married couple. So just know the analysis on that IRA. You certainly don't want to be making an IRA contribution and then find out it wasn't tax deductible, because you lose the benefit of that IRA. So not to say you can't do an after-tax, a non-tax deductible IRA and subsequently convert it to a Roth. That's a little bit more of a unique proposition, and I see that I'm running out of time, so I'll just put that one out there. That high income levels, you may want to, that is an option. But bottom line is, the analysis starts first with, does my employer have a retirement plan? If the answer is no, then you can do it. If the answer is yes, then the analysis gets much more complicated, starting with how much money you make. Anyway, we are out of time. We will have to wrap it on up here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning. You've been listening to us here on News Radio 102.5 WFLA and also on 540 AM. Have a great rest of the weekend. It looks like it's another beautiful, we're a little bit cooler out there today here in Central Florida. So enjoy your Sunday. Have a great one. We'll talk to you all next week here on the program, Dollars and Cents. with Joel Garris of Nelson Financial Planning.
This is Bud Hettinger, and you've been listening to Dollars and Cents with Joel Garris of Nelson Financial Planning. If you missed any part of today's show or want to listen to it again, check out the radio show at www.nelsonfinancialplanning.com or connect with them on Facebook or Twitter. Be sure to call Joel this week at 407-629-6477 to schedule your free consultation to discuss your retirement plan.
How have your investments performed over the past 5 years? Do you know? Are you happy with that number? At Nelson Financial Planning, we've been achieving investment results over the past 30 years using actively managed investments that we own personally. This is Joel Garris, and I invite you to review your investment results with us. Visit nelsonfinancialplanning.com or call us today at 407-629-6477 to set up a conversation to review your investment performance. That's nelsonfinancialplanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC at FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 102.5 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.